questions. So for the answers for case studies will be published under the learning portal. Okay. So for every lesson, before we start, we'll show this QR code, this to capture your attendance. So do clock in your attendance, but at our end, we also do a manual check of the attendance. Okay, the exam will be held on 12 April. Later, I'll go through the admin details with you. So some house rules for the Zoom lesson. So once the session start, right, do turn on a video. The purpose is to show that the trainer can see your face and to see if you understand the lesson by showing your facial expressions. So we do encourage you to turn on a video. And then there'll be no recordings of the lesson. So please do pay attention and avoid doing other stuff. And then if you have any questions, you can just unmute yourself and ask the trainer your questions. Or if you are very shy, you can just post your questions under the chat. But for chat questions, right, the trainer can only address them after the break because she need to go through the questions. So she will address them after the break or before the end of the session. Okay. So I stop the attendance first. I will share about the exam details. These are already available in the portal. It's the exam file. Okay. So yeah, take a while. Okay. Yeah. So this is the exam details. So exam will be held on 12 April. The writing time will start at 9 a.m. and end at 12:15 p.m. Venue will be at IRAS building, the 5th story, multi-purpose hall. Okay. So things to bring along will be your NRC and secondary ID. Secondary IDs can refer to your passports or credit cards that have photos, as we'll check your name. And then do bring in your calculators, but handphone calculators are not allowed. Stapler for stapling the exam papers. And mobile phones and smartwatches are supposed to be on silent mode and placed inside your bags. And so do bring along all your stationery items, as we will not provide these items. So before you come for the exam, there'll be a attendance code for you to scan your attendance. And the year of assessment to be tested is YA 2022. The examination will be closed book. So you can't bring anything except you can bring along the Income Tax Act or the GST Act, but these are not compulsory. Actually, it's not much time for you to flip through the act. So if you want to bring, then you can print from this website, the AGC website. So for your act, right, you cannot do any tagging or highlighting or scribbling. Yeah. Okay. So for those acts that are published by CCH or LexisNexis, these are not allowed. Please note this. So examination questions, there are 5 questions testing on these various topics. So for all the, it would be good to attend all the 5 Saturday morning sessions, because the trainer will go through with you the materials and also go through case studies, which should be useful in your preparation for the exam. Okay. So it's 100 marks. Yeah. Total marks is 100 marks. Yeah. So do you have any questions before we start? Oh, sorry, there's another more briefing on how to use Zoom, but this is a very short one. Okay, the sound settings. This is a very short briefing now. I think most of you are very familiar with Zoom. So if you need to unmute yourself, click on the unmute button. And then video is where you start or stop your video. And if you wish to see both the trainer and the slides, you can click on these view options and then side-by-side mode. Chat is, where you post your questions. If you wish, there's also a function in the Zoom where you can click on this raise hand function, and then Zoom will notify the trainer, and then you can post unmute yourself and post your questions. The chat, just now I mentioned about the chat, so I skip this. Annotate is when the trainers may have questions on the slides, and then they may ask you to type your answers on the slides. So yeah, this one is under view options. And breakout rooms, we may have breakout rooms. So for the case study discussion, so you'll be break out into various groups for your case study. One group will have around 5. So within your group, do discuss, and then And you may also need to type your answers in the PowerPoint slide and then share your answers. So if you need help within the rooms, you can click on ask for help. Then we will join the room to answer your queries. Yeah, so in the countdown, the breakout room, you also see a countdown timer, okay? Yeah, so there will be breaks in between the classes. For today and next week session, there'll be 2 short breaks at 10 plus and 11 plus. So yeah, any question? Someone asked if the sessions are recorded. The sessions are not recorded. So do pay attention to the class. Somebody also asked about cannot turn on the video because don't have a webcam. That's fine with us. But so far now, nobody has turned on except me and the trainer. Can you turn on your video? So that at least we can see some people. So we won't start if you all turn on. No, just joking. Can some of you all turn on because we don't know if you are there or not listening to the class. Okay, so still nobody wants to turn on. So I pass over to Shani. Yeah, thank you, Shani. Shani is from IRAS. Yeah, so she will be going through with you with the income tax and corporate tax for these 2 Saturdays. Yeah.
Okay, thank you, Lei Hong. I'm Shani from IRAS. I am your trainer for this week's session and next week. So for our 2 sessions, right, it will be from 9 to 12:30. I will start the lesson on time. So like next week, please be on time. And then there'll be 2 breaks. One at 10 minutes break, one at around 10 a.m., another at around 11:15. So just anyway, you get back on time on the breaks. So for just some house rules, generally you will mute yourself, but if you wish to raise questions, you can unmute. And I would personally, I'll prefer that you unmute and raise questions as and when I touch on the topics. If you find anything that's not clear or you wish to seek clarification, you can just unmute and ask the questions. Or if any point in time you think that I'm speaking too softly or anything, you can just let me know, or let's say the slides are not moving, just in case. If there happens to be that there's a break, something I just disappear from the meeting, just give me some time to get back. Okay. Okay, so before I start, right, I would like to just get to know you. So okay, so for the format, right, for the class, there won't be any breakout rooms. Although I have your name list, I won't be asking you individually to answer questions. But what we'll do is that we will have poll questions. So these poll questions will be at appropriate section to, after covering certain topics, I'll just launch a poll so that everyone can participate, and then it's anonymous. So you just indicate, for example, what's your answer, and then from there we'll see, so that I can see whether I need to go through the topic again, or where, depending on the poll results. So this is how we will conduct the session. Okay, so most of you, okay, sorry, just now there was some technical thing. I wanted to show this poll later, but okay, I just show the results. So for the poll, okay, I think about half of you don't really do corporate tax in your work. And then for the tax computation, only about 16% actually does it quite often. The others, not so familiar, and not really sure what it is. Okay, I'll keep this in mind. Okay, the reason why I'm asking this question is, okay, I mean, I'm also, I have objective in mind. So you will see that for these two sessions, the modules, if you are looking at your textbook, right, there will be modules 2 and 3. It's about 200 pages of content that you are looking at, which is a lot. Okay, so it's not just equipping you with the essential knowledge on corporate tax. It will also be, I suppose most of you will also be taking exams at the end of the session. So I also want to ensure that you have enough to let you do well in your exams. Okay, so sorry, there's something wrong with my Zoom. Just give me a moment. Sorry, I think I need to leave for a while. Lei Hong, meet me later, because there's something wrong with the screen. I'll leave first.
Okay. Okay.
Okay, sorry about that, because the screen keeps flashing. Okay, so Lei Hong, can you share the co-host function with me? Okay. So that I can launch the co-host.
Oh, okay, yeah.
Okay. So there'll be thank you. So there'll be quite a lot of things to cover. Okay, so when you ask questions, I hope that you will just limit yourself to the content of the slides. Okay, if you have your own questions, or if you're a tax agent, if you need any clarification on your own work, right, please can either call the IRIS helpline or you ask your senior, because I want to ensure that I cover all the things that will be in the exams. Okay, as what has been shared by Lei Hong just now, okay, you see that in the exams there are 5 questions. So for your info, for this topic that we'll be covering for today and next week, there'll be question 1 and question 2. In case you have not noticed, that is question 1, 25 marks out of 100 marks. Question 2, 25 marks out of 100 marks. So for question 1 and question 2, it takes out 50% of your exam. So question 1 will be more like short questions and answers. Question 2 is a computation question, which is why just now I'm asking how many of you actually do computation often. So I think the thing is that if you don't do computation often, it'll be a bit difficult for you. Exams, you have 5 questions to answer, there'll be time pressure. So later on, I will also be going through the computation with you, and especially for those who have not seen a tax computation before, or you have not done it often, I will highlight to you, like what is the format and what are things that you should look out for. And this is also from, okay, I'm also the person who sets the exam questions and marking the exam. So I will also point out to you, some of the mistakes that I see. Okay, just that you don't make the same mistakes. These are all general type lah. And also for exams, right? I would just like to let you know that for exams, because I'm the marker, okay, everything that I say today on certain things, you only be applicable to question 1 and question 2. Okay, so it will not be applicable to other questions. So for example, for question 1 and question 2, you are not required to quote what is the section of the act. Okay, so I won't say like quote, like you have to quote like section 14 something of the act. That is not necessary. Okay, so these are things to know. So as I go along the way, I'll just highlight to you the things to look out for lah. Okay, let me share. Give me some time to share the slide. Okay, so I'm sharing the slides that we'll be covering. So there's part 1 and part 2, but generally we'll see how it goes lah. Okay. This will be what we'll be covering in part 1. So just talk briefly about Income Tax Act. Then we'll talk about the tax computation. Then the basis period and tax rate for companies, the charging principles, and deduction principles. Okay. So for the Act, just very briefly, we used to have this Income Tax Act, Cap 134. Now we are looking at a new Act. Okay, so for the new Act, they actually maybe reduce the lengthy provisions to shorter sentences so that it's easier to understand. That would be the main reason. But I mean, not really for this exam, it's just that in my slides, I'll be telling you, for example, this is section what. Like I said, you don't need to quote it in your exam, but it's just that for the purpose of teaching of that, of course, I would have to tell you, what section it is. Okay. Okay, this is just very okay for tax computation. Okay, I think you would have your case studies tool. You have your case studies questions and answers with you. Can you take them out now? Okay, so for those of you who don't really know what tax computation is, so as I explained, right, question 2 in the exam, it is actually a tax computation question. Okay, so for tax computation is because we're doing corporate tax, right? So we will have info on what is the company's revenue, expenses, its net profit, and then from this we will have to make some adjustments to that to derive at what is the tax payable. So this is what the tax computation is for. Okay, so in your tax computation, you do adjustments to take out the non-deductible expenses, take out the non-taxable receipts. Okay, I'm just giving you a very brief idea here lah. Okay, later we'll go in depth. Okay, so I mean, we have all these examples here, but what I'll prefer to do is for you to refer to the case study question 2. Okay, for most of things that I say on the exams, right? At the end of the second session, where we have time, I will go through them again. But of course, it may not be everything, may not be in detail everything, but I will go through them again in case there are some people who missed it. But sometimes at certain sections, will be in more detail. Okay, so I hope that you have your case study question 2 with you now. Okay, so sometimes I may be a bit exam driven, so I just want to prepare you well for the exam. Because especially for those who don't do your tax com daily, I think it's a bit difficult. Okay, so you have your question 2. You will see that it says tax computation practice. Okay, so this is a very simplified profit and loss statement. So this is what you will see in the exam. Okay, so we'll give you something like this. Okay, so if I look at profit and loss, you will see some info on like the sales. Okay, so the part up to $957,000 to be all, which includes your income from other sources. No worries, I'm just giving you a high level overview here. Later on, as we go to each topic, I'll highlight the section again. But just let you have a good overview here. Okay, so we have the top will be like sales, income, then maybe something to do with inventory. Then at the second half, you have your different type of expenses. Okay, that's what you see here. Okay, and then then you see it ends with net income. Okay, so this is what we will be giving you in the exam, something like this. Okay, so we'll throw a lot of things here for you to make adjustments. Okay, the thing is that you cannot just look at this page. You should turn to the next page, right? Page 2. You will see that there are notes. Okay, so for each relevant item, we'll say like note 1, note 2, note 3. So all these notes, they are important. They will tell you, give you details of the things. So from these notes, you will need to make some adjustments. Okay, so this is the information that is critical. Okay, so I suggest that when you look at it, you also take a look at the notes. Okay, so they have some idea of what are the adjustments that you need to make. Okay, so from here you can see that at least for this, we have up to what? 14, note 14. Okay, then as what the Lei Hong has said, right, the tax computation will be for YA 2022. Okay, and you will need to show workings. Okay, so you will need to show workings. By workings, I mean, for example, you may there'll be what we call capital allowance computation, or R&R computation and things like that. Okay, we'll be going through them later, but just to let you know. So you will have to show workings. Okay, and I like to highlight to you the last sentence in the question. Assume that the company has applied accelerated deductions, capital allowance where applicable. So this is a requirement to say that. So like those of you who are familiar, for example, for capital allowance CA, there can be accelerated type or not accelerated type, 3 years, 2 years, and things like that. So this is a requirement. So you will have to prepare based on what is stated in the exam question. Okay, so I hope that this will help you a bit in the exam, so that you know that this is what that you need to look out for. Okay, so then we move on to the computation answer. That is also in your case studies, right? So this is what is a typical, ideally if you do your answer, this is how you actually present your tax computation. Okay, so you will see the net profit, then we'll less out the separate source income. Okay, because if you refer to the profit and loss statement just now, you will see that this net profit actually includes non-trade type of income, like dividend income, interest income. Okay, later we'll go through all this again, but I just like to let you know, okay, also how I mark the things. So marking scheme is quite simple. For every item, there will be points allocated. So for example, one sure point that you can get is you copy the net profit, right? You'll get 0.5 marks already. Okay, so for each item that we will give points on, it will be another 5 marks, like 0.5 marks, 0.5 marks. Okay, so you will see that in this question, right, I don't need you to say, for example, there may be some income, for example, they're exempt from tax. I don't need you to indicate, for example, why it is exempted. It's just that you just exclude them. It's just like a normal practical tax form. Okay, so I hope all this can help you be more prepared for exams. So this is what you don't need to. Okay, maybe second half of it, you can see that this ad, like dividend from DBS Bank Singapore, exam under the act, certain act, right? This is for the purpose of just case studies to let you know. For an exams, you don't have to do that. Okay. In fact, if it's exam, you don't even need to include the item inside. You only include what is taxable or what are the adjustments that you need to make. Okay. Like I say, you don't need to give reasons. Okay, you just put in whatever is the item. And really, I don't need you to, because of time, I can understand for time constraint, right? For example, let's say I'm doing it now. For example, you put like from the top, separate source income, you can just put like dividend DBS Bank, dividend Bank Negara, Indonesia. I'm okay. You don't need to like do very nicely. Okay, point forms, all this I'm okay, but just make sure that whatever that you write is clear. Okay, and some of the adjustments that you make, don't lump them together, because like each point will be given for each item. So for example, if you lump like dividend, if you just write like dividend, then 45,000, I mean, this is still okay lah. But in case there are some adjustments that you need to make, then you just put a lump sum. I don't know which expenses you are excluding, then you don't expect me to try to figure out what you're including, what you're excluding. Okay, so I hope this is clear. You whatever that in each point, you just write them down for each item. Okay, because I've seen people like when they put expenses, right? Because there are some notes, for example, miscellaneous expenses, there could be a few items that you need to exclude. Let's say it's 300 for A, 200 for B. Some people, they just put like 600. Then like, it's like, they want me to like, figure out for them what they put down. I mean, I won't be doing that. Okay, so, then, sorry, I saw there's this question on where can I access the case study questions to? Would anyone in the class be able to help your help one phone, because I'm not sure where you get it administratively. I thought that it would have been printed out to you for all the case studies. Okay, Tax Academy say that it should be together with the set of case studies. Okay, so one point I think you have to maybe look through again. Okay, so yeah. So back to the tax com, right? So I hope that for every point you are clear. I mean, you're helping yourself also lah. Okay, so if you flip to the other page, those are the workings. So for example, where working is applicable, you can just say, for example, in your tax com, you say C workings, then you have all these workings behind. So points will also be allocated to all these workings. So please be clear also on the workings. Okay, similarly for the capital allowance, you can see here that we put under what section. That is more for the purpose of case studies to help you understand how it is being done. In your exams, you don't have to put the sections. Okay, but you need to be clear. For example, you show me like, for example, it's where you need to like divide by 3. You have to show me like divide by 3. if you don't know what I'm talking about now, it's okay. Later on, we'll be moving on to the capital allowance, but these are the things that I just want to highlight now, huh? So I think if you are familiar, at least if you are familiar with the format, it will take away some stress from the exam. Okay, and really the exams, we'll be throwing a lot of things. It's a practical question, so you have to think of what are the adjustments to be made. Okay, later on, so you keep this question 2 on hand, because what I prefer is that as we go through the theory, I also go back to the text com to highlight to you what are the workings they need to do, or how you should actually reflect them in the text com. I think this will help for those who are not doing the text com often. Okay, so you keep your case study with you lah. Okay, so if I go back to the slides that I'm showing. So you see that here we have an example of a trading company tax com. Okay, because that case study is in the is a bit long, right? So I just want to show you very briefly. This is a very, very simplified tax computation. Okay, so you have your net trade income. Okay, then you will have to actually add expenses that sorry, admin things I can only say. Okay, next week before we end the session next week, I'll be going through briefly with you again, but on the text com. But yeah, but I mean, it can't be helped lah. I'll still be referring to it as and when I need to. Okay, so we have the net trade income, then you make adjustments to the expenses. Then you have to, for example, add whatever income that is taxable, allow expenses. Then you will see here that we have a chargeable income of how much. Then you have your exam amount. Okay, this exam amount, if you refer at the bottom, this exemption details, it applies to all the tax com. Then it's just that whether that amount, that 7,500 is the same or not, really depends on what is the chargeable income. So this information will be provided to you in the exams, but you have to do the computation. So lastly, we have the chargeable income, and then what is the tax payable, how we compute the tax payable. This is a very simplified tax computation, strip away of all the other complications, but this is how it looks like. Okay, but like I say, if you refer to the question 2 of your case studies, that will be something that you can expect for the exam. Okay, before I move on, any questions? I'll prefer if you all use the mic, then I can then check the chat. Any questions you'd like to use? But like I said, this is just a very high level thing to let you know what is required of the exam. For specific sections, topics that we'll be covering later, I'll go back to this text com. Yeah. Okay, so for those who join us late, just to highlight that for this text com, you don't need to quote sections, you don't need to say what is the reason for including or excluding certain things. It's just purely a computation question, but you will need to show workings. Okay. Okay, so with that, move on. Okay, so this text computation, right, that you see here is what we call the indirect method lah. Okay, it starts from net profit, and then starts from net profit, and then we'll make adjustments now, like we make changes to the tax com. This is called the indirect method, and this is for trading income, trading company tax com. For the exam, we'll be doing a trading company tax com. Okay. There's what we call the direct method. Okay. Direct method, we won't need you to do it in the exams, but just to show you, like, okay, whatever is in the supplementary slides, it won't be tested in the exam. Okay, but I just want to let you know, for example, we have, and the tax com in exams will be for normal companies. It will not be for new startup companies. Okay, because new startup companies, they have different type of exemption amount. So because of time constraint, I won't be covering this. Okay, but if in your daily work, if you need them, you can take a look at them. Okay, we also have the investment holding company. Okay, just now I mentioned about the indirect method, right? For investment holding company, usually we do the direct method. What we mean by direct method? We start with, I don't start with net profit. I'll just look at from the P&L, profit and loss statement. I'll take out what are the incomes that I need to bring to tax, allow expenses, then I work from there. So it's direct, instead of working from net profit the other way around. So we won't be testing the direct method in exam. So meaning I won't be testing you on the investment holding company tax com. So it'll be more on the indirect method, as what you can see in the case study too. Okay, so I will start the content. Okay, any questions on the tax com? Okay, if not, then I will start the content, start on the content itself. Okay, first thing is on the basis period and the tax rate for companies. Okay, this is very, very important. I think for those of you who are doing corporate tax, then no issue, but I think for a few, I want to just emphasize on this because this is the most basic. Okay, so for Singapore, right, we adopt what we call the preceding year basis to tax all sources of income. Okay, and the tax for each year of assessment, YA, is based on a person's income earned in a year preceding the YA. Okay, so for income tax, we have the year of assessment concept. Okay, I just touch a bit on the individual first, although you have a trainer for individual, but we get this right first. So for individual, the basis year is a preceding calendar year. Okay, so I'll use YA instead of year of assessment. So for YA 2022, we are looking at income earned in the calendar year, preceding year, the year before, preceding calendar year before. So it's the calendar year 2021. Okay, so you just remember this info. That will be for your individual question. I think you also have a tax com also. Okay, so this is for the individual side. So for question 1 and question 2, we are looking at companies tax. Okay, so for company tax, the basis period is a bit different. We are looking at the accounting period ending any date in the preceding year. So accounting period, it can be any time in the year. The more common ones we'll see, for example, will be like 31st March, 30th June, NSET, and then 31st December. Okay, but actually it can be any dates. So for a company, for the assessment, for example, here we are looking at YA 2022. We are looking at the profits for the accounting year ended 30th September 2021. So just to give you another example, this year is 2023. We are looking, this is YA 2023. For the company, in this case, for example, we'll be looking at the profits for the accounting year ending 30th September 2022. Okay. So this is a very, very basic concept. You need this in your, you need to know this so that, for your tax com and questions, in case, there are some that give you things that are not within the accounting year, you need to be able to know what to include, what to exclude. Okay, so this is just a pictorial presentation. For companies, you can see that it is not necessarily a calendar year. We are looking at the accounting year. Okay, just to do a quick understanding, see whether you understand what I've said just now. I will launch a poll. Okay, so you see these questions there. Maybe we can answer them. I'll end the poll when most of you have answered it. Okay, I think most of you have answered the poll. I'll end the poll and then we'll see the result. Okay. Share result. Okay, so for the first question, right? I have financial year ending 30th March 2020, which YA is applicable. So most of you answered YA 2021. That is correct. Okay, so what we do is that for YA 20, so if your FY financial year ends in somewhere in 2020, okay, that is the basis period for something forward. So that is for YA 2021, meaning in YA 2021, I look at what is my accounting year, what is my financial year ending. Somewhere, it should be somewhere in 2020. Okay, so we are YA, we look back. Okay, so we can only compute income tax for Singapore. We are looking at preceding year basis. We compute income tax only when the financial year has ended. Okay, so the financial year needs to end already. Then we look at what is the YA. I mean, that is a general rule, not for those liquidation case or things like that, but that's a general rule. Okay, so for YA 2021, we look back at the financial year must be closing somewhere in the earlier year, 2020. Sorry. So the same goes for, okay, so for if we have a financial year ending 31st December 2021, okay, this is the basis period. So it's usually for our YA, we'll be looking at something that happens in the past. Okay, so that will be for the applicable YA will be YA 2022. Okay, so I hope that this is now clearer for those of you who didn't get this question right. If you need any clarification, you can raise them. Okay, like I said, this is a very basic concept. You need to make sure that you get this concept right. I think it's good, like at least with the poll, it's more interactive, then you can know how whether the explanation is clear or not. Not that I'll explain again. Okay. Okay, I hope we have now get our YA concept, financial, the basis year concept correct. Okay. Okay. So for corporate tax, right? Like I say okay, a lot of things that I say may be geared towards the exam, but it can't be helped. I really hope that I can help you all do well in your exam, but yeah. So for this, okay, so this year is calendar year 2020. 2023. It's YA 2023. Okay, our exams, the question will be on YA 2022. Okay, so for YA 2022, right, we have the partial tax exemption. This is for the normal companies. It's not for the newly set up companies. So we have the partial tax exemption of a certain amount. Okay, so it's 75% of the first 10,000, 50% of the next 190,000. Okay, so it really depends on what is the income, the chargeable income. So if you look at this 10,000 and 190,000, this is more for chargeable income of 200,000. Okay, so if you refer to your TaxCom answer, right, page 1 of your case study, question 2, right at the end, you can see that there's this partial tax exemption stated. And also in your TaxCom, you definitely, unless it's a loss, if not, then you definitely have this part. So you write this down. But of course, depends, your calculation may vary, but if you have this down, then you can get marks for it already. Okay. The tax rate, if you look at the tax form, when you get all your chargeable income, lastly, you have to apply the tax rate. Okay, so in this case, for a normal company, it's at 17%. So for Singapore, the corporate tax rate, the headline tax rate is 17%. Okay, this is a flat rate that is applicable regardless of whether it is a local company or foreign company. Okay, and this 17% is for most companies, just for your info. Okay, when I say for info, it's just like for info, not so much of the extent. So for info, there are companies that may be enjoying certain tax incentives. They may be paying a tax rate of 5%, 10%, for example. So in those type of tax com, you will see that we have one column for income where it's taxed at 5%, another column which, let's say the income is taxed at the normal tax rate of 17%. Okay, but for the exams, it's just one column, it's just 17%. Okay, so at least for those of you who are not familiar with the tax com, I just want to highlight to you that for this part, it's at the end of the tax com. Okay, and this information, whether it's 75% on the first 10,000, this will be provided in the exam question. Similarly, on the tax rate will also be provided. So you don't have to memorize this, but I mean, you have to include this information in your tax form. Okay, any questions? Okay. Now, move on to the general charging principle. Okay, someone say, what is income tax about? Okay, if you look at it very, very broadly, very, very high level, it's about you have your income, you have your expenses. So the question is, for income, is it taxable or not taxable? Okay. For your expenses, is it deductible or not deductible? Okay, so generally for a company, right, the higher the income, this will mean that you need to pay more tax. Okay, or if you can claim more expenses, then you claim less tax. So that is the thinking behind it. For charging principles here, we are referring to the income part. Just I talked about income, right? So with income expenses, now this is on the income part. Okay, so for a company can be receiving a lot of what we call receipts, inflow of funds, receipts. These receipts, right, it can be what we call capital receipts or income receipts. So for Singapore, there's no gain on capital, no tax on capital gain. So meaning that if an receipt is viewed to be what we call capital in nature, we will not be imposing any tax on this. Okay, but if it is an income in nature, it may be subject to tax. Okay, so what is important is that when you look at the receipts that is received by the company, we need to know whether they are income in nature or capital in nature. Because if it's capital in nature, definitely you know, okay, I don't have to include it. It's not, I think it's not taxable. Okay. The thing is that in our Income Tax Act, right? I mean, the principle is very clear, lah. Capital receipts, no tax. But the thing is that when it comes to actual practical work, where is it income, revenue in nature? When is it considered as capital in nature? That's when we have some problem with it. Okay, so, but the thing is that in our act, right, we don't have a definition to say when you see this, it means that it is capital in nature. We don't actually state very as in you cannot just, it's not so clear lah, which is why we have a lot of, we may have disputes on it. It is not uncommon for companies to report that, for example, they view this to be capital in nature, so it is not taxable. But for example, for IRAS, anyway, I'm from IRAS, so for IRAS, may view it as maybe this is taxable, so you have to pay higher tax. Okay, so but although the act does not actually give the clear definition of what is income or what is capital receipts, we can actually draw from case laws, we can try to draw some principles to distinguish the two. Okay, for case laws, these are cases that have been brought to court, and then the judge has actually looked at the facts and then decide on, for example, okay, based on this set of facts, this is capital in nature. Based on this fact, this is income in nature. So over the years, there are a lot of cases that are brought to court, not just Singapore court, it could be also overseas, okay, and also at different levels of the court. So based on all this, maybe we can distill some principles from the case law. Okay, anyway, for the exams, in your textbook, right, you will see that the case law, they will state what who versus who line, things like that. In your exams, you don't need to quote case laws. Okay, so I just want to highlight for practical, more for info, for even if you're looking at case laws, right, you need to be careful. Although we may actually refer, maybe we can look at what is the case law of other countries. There are certain cases, like this income, whether it is capital in nature or not. We really have to look at the wordings of the act, whether is it similar, is it the same as Singapore? Is it similar to Singapore? Okay, so if not, let's say for this payment, maybe in let's say South Africa, they say that it is capital in nature, but maybe in Singapore, due to the different wording in the act, it can be viewed to be income in nature. So it can be different. So you need to be careful if you need to refer to case law. And for Singapore, right, what can happen is that, for example, if you're a taxpayer, you do not agree with IRAS that this income is taxable. Okay, so what you can do is that you can actually bring your case up to the what we call the Income Tax Board of Review. Okay, so this board, I know this is all for info. This board will decide, okay, based on the fact the case will be presented by the taxpayers' lawyers and then by the IRAS lawyer. They'll look at what has been presented and then decide on whether it is capital. Like who applies the correct treatment. Then if, for example, the board of review decided, let's say IRAS win, for example, we should adopt IRAS's tax treatment. If the taxpayer is not happy with it, they can bring it up to the General Division of High Court, where the court would then decide, look at the facts again, okay, and then decide on what is the tax treatment. So because the General Division of High Court is a higher level than the Income Tax Board review, then of course, whatever decision that they make will actually override the Income Tax Board review. So meaning when we are looking at case laws, right, where let's say in your work, you need to quote case law, you need to look at case law, you also need to look at which level is the judgment being decided on. Okay, so usually the higher level will override the lower level. So in this case, if let's say now the High Court decides that, okay, the taxpayer actually applies the correct treatment, Iris is actually wrong. So then next time, if we have the case that is like exactly the same, then we'll need to look at this High Court decision and not Iris's decision. This is the general rule on how we apply. If you look at the previous case laws, you may also see that in Singapore, we have this Court of Appeal. Yeah, last time after High Court, we used to have the whoever the losing party can actually appeal for the case to be brought up to a higher level, which is the Court of Appeal. But I think this few years, we no longer go to the Court of Appeal. The highest level that we can go up to is the High Court. This is just for info only. Okay. Okay, so what I've said, right? For the income tax, well, for the receipts, we are looking at whether the income is capital in nature or is it income in nature. Okay, why is this important? Like I say, it's not just theory. When it comes to tax com, right, we need to make adjustments to your tax com. Okay, so when it comes to tax com, because we are using indirect method, we start with net profit, right? Above, you already include a lot of income like receipts, whether it can be capital receipts or not. So when you are doing your tax com, you need to, if it is a capital receipt, you need to exclude, take this out. You need to make adjustments to say, for example, less what is the capital receipt. Okay, but if it is an income receipt, since it has already been included in the net profit, you may not need to make adjustments. I say may not, because in case sometimes you still need to make some adjustments, but you need to make sure that it's brought to tax, but you have to see whether there's any adjustments to be made. Okay, so this is just high level. So, okay, what you need to remember is that there's no capital gains tax. Okay, so sometimes in your exam questions, question one, it could be short questions and answers. So there may be some, we'll ask you, for example, whether a receipt is taxable or not, certain receipt is taxable or not. It could be very well that the reason is that it is actually a capital receipt and it is not subject to tax. Okay. It's now 10 a.m. I think we'll go for a short break. Okay, then we continue. It's a 10-minute break. Anyway, it's 10 a.m. on my clock. So we'll come back at 10:10. Okay, so I'll see you all later.
Zoom name is BRH. And then there's someone who is Samsung. Can you rename yourself? Because I'm not sure what's your full name. For the BRH Zoom name, can you rename yourself or let me know what's your full name? And there's another one who is Samsung. I'm not able to take attendance. Can you rename yourself? Or then if you're not right, I have to put you to waiting room.
Hello everyone. I hope that you are back. Actually it's 10 now, because I can't really see you. I just assume that you're back. Okay, so I will continue. Okay, so we're talking about the receipts, right? Okay, so I mentioned that in the act we do not actually prescribe what is capital, what is income receipt. So, but there are some tests that we can apply to distinguish between the two. Okay, so the first test is we are looking at whether the receipts are actually related to assets forming part of the permanent structure of the business, or test 2, whether it's fixed or circulating capital. Okay, so if we look at test 1, we're looking at whether it's a permanent structure or not. Okay, so for if it is a receipt that is relating for capital, those that are capital in nature, right? It actually relates to assets forming part of the permanent structure, part of the permanent structure of the business, and are the means whereby profits are earned. So you receive this that it is actually from something that forms part of the permanent structure of the business. Okay, but if it's something that is revenue nature, we are really looking at relating to the subject matter of trade. Okay, I mean, when I say all this, you still be thinking like, like that. But I think as we go through, then maybe it'll be clearer. Okay, so we can look at 2 case laws here. So for the case law on the left, the Vandenberg's, I mean, this is just for info only. Like I say, you don't have to quote case law. You don't have to talk about like this case law say or what. Okay, so in this case studies, we're looking at, in this case law, we're looking at Vandenberg. So there are 3 agreements which are cancelled, but they are not the ordinary commercial contracts made in the course of carrying a trade, but they're actually related to the whole structure of the company's profit-making apparatus. So in this case, where they actually cancel the commercial contract, the agreements, right, and they actually receive a payment from this cancellation, it is viewed to be capital receipt because it constitutes a capital asset of the company. Okay. Then on the other case, it's an agency contract which was terminated, and it was actually one of the various trading contracts entered in the normal course of business. Okay, because it's normal trading contract, it's one of many entered in the normal course of business. So in this case, when the company received the compensation for the termination of the contract, right, it was held to be a trading receipt. Okay. So you can see 2 things here. One is if it is something that is in a normal course of business for your you receive from it or this contract, that is considered trading receipt. But if it's a receipt that is received that affects the structure, the profit-making structure of the company, then it is capital receipt. Okay, if you wish to read up on the case laws, you can actually refer to the textbook that you have. Okay, so more for your info, but here we're just trying to look at the principles that we look at. Okay, so anyway, we'll just do a poll. Okay, just to check understanding. Okay, so in this poll, okay, so here we are looking at that you have actually signed a contract for a franchise in Singapore, but the contract was terminated and you were actually compensated with a sum of money. Okay, so what do you think? Do you think it is revenue receipt, whether it's a capital receipt or not sure? Okay, most of you have answered. I'll just end the poll and then I will share the result. Okay, so about 2/3 of you say it's capital in nature, about one third say revenue. Okay, so in this case, the answer is capital in nature. Okay, why is it capital in nature? Because, okay lah, so if you look at it, the contract is terminated. And so when the contract for the franchise is being terminated, it shows that this will mean that you won't, the whole, let's say the business, the franchise that you're running, right? You can no longer run the franchise. So it affects your profit-making structure. Okay, so it affects your profit-making structure. You will actually lose the income source. That's why it is actually a capital receipt. Okay, versus, for example, so you're in the franchise, and for your, let's say, business part, your customers, you have a contract with them to say you have to supply certain goods to them. And if that, for some reason, they say, okay, now, although it has been stated that you need to supply this food to me, for some reason, now I'm going to cancel this contract. Okay, you don't supply to me anymore. But you enter into all these contracts with many customers in a normal course of your trade. In this case, if there's a termination of that contract, trading contract that you have with your customers, then it will be revenue in nature. Because even though this contract has been terminated, it does not affect the whole structure of a business. You can still continue to do business. You are not affected by it. Okay, so this is the difference between the two. Yeah, I hope this is a bit clearer now. Okay, right now we still have another test. It's actually quite similar, but we'll go through this test. So the other way that you can look at it is whether the receipt is from a fixed capital or from circulating capital. Okay, so if it's a fixed capital, it is what the owner turns to profit by keeping it. Okay, by keeping it. If it's a circulating capital, it is what he makes a profit by letting it go. Okay, by selling it or parting with it. Okay, so if it is a receipt relating to fixed capital, then it's actually capital in nature. If it is a receipt that you receive from your circulating capital, then it is actually revenue in nature. Okay, so if it's fixed capital, it's an asset that forms part of a fixed asset if it is retained in the business with the profit of producing profit, object of producing profit. If it's a circulating capital, it's an asset to be part of a circulating capital if acquired in the ordinary course of trade and is sold or is used in manufacturing what is sold. Okay, so circulating capital, you either sell it or it's like raw material, you use it to produce something else, then you sell the product. So if that thing is a circulating capital, then it's income in nature, whatever they receive from it. The other thing is if it is a fixed capital, then the receipt that you receive, for example, from selling that fixed capital is a capital in nature. The thing is that, one asset, right, it can be viewed as a fixed capital. In another scenario, it can be viewed as a circulating capital. It really depends on the facts and circumstances of each case. Okay, so what example to elaborate? So for example, if I'm talking about a car, is it capital? Is it a fixed capital? Is it a circulating capital? If I just ask this question, I don't think you can really answer me because we really have to look at the fact. What is the person doing with that car? Okay, so for example, if it is a trader that is in a business of buying and selling cars, so the cars will actually form the circulating capital, right? Because they have to sell the car to get the money. Okay, that is a part of the trade of selling cars. So that's a circulating capital. Okay, on the other hand, if let's say this motor car is actually owned by a taxi driver and use this car as a taxi, right? So this car is his profit-making structure. It forms part of his fixed capital. Okay, so when let's say he sells the car, he receives a receipt, that's capital receipt. Okay, if you look at something bigger, a building. Okay, a building, in most circumstances, people would think that building should be fixed capital, right? Because you usually use your house inside a building and use the building as a premise for something. That's usually the case, for example. In this case, where a building is actually constructed by a manufacturer for its use as trade, so it's actually fixed capital. But of course, there could be other people where, for example, a developer, it is in the business of actually building buildings. It could be, let's say, housing or factories, for example. So for this developer, in its course of business, it is actually selling property units. Okay. So in this case, this property unit will be its inventory, its stock in trade, that is circulating capital. So for the receipts that you receive from selling of this unit by a developer will actually be circulating capital, that is revenue in nature, income in nature. So this is what we mean by, even for an asset, under different circumstances, it could be fixed asset, fixed capital, or it could be a circulating capital. Okay. Okay. So here you're going to do another poll. You're in the business of buying and selling of used laptop. Then you keep a laptop to generate invoices and to record purchases and sales. Okay. So in this case, this laptop that you use to generate invoices, is it a fixed capital or is it a circulating capital? Okay, I will end the poll. The result. Okay, most of you said that it's fixed capital. Okay, you are right. It's fixed capital. So in this case, right, we are looking at although this person is in the business of selling laptops, but now my question is on that particular laptop where the person actually used to generate, where it's actually used it for its work for part of its trade. It does not actually sell it. Okay, it used it to generate income in that manner. So actually that laptop that person keep, right, which is used for generating invoices, it is actually a fixed asset, a fixed capital. Okay, so the answer is that it is actually a fixed capital. Okay, moving on, still on income. So there are some rules that we can, some principles that we can see on determining whether it is capital in nature or revenue, income in nature for an asset. Okay, but some of them may not be conclusive. So, okay, so the first one we look at, it is a payment for the sale of assets used in a business to generate income. Okay, so in this case, because we mentioned that it is an asset used in business to generate income, that is a fixed asset. Fixed capital is capital in nature. Okay, for profits received, for payments received for the destruction of a profit-making apparatus, okay, because it affects the profit-making structure of the company, it is capital in nature, capital receipt. Okay, for payments that are actually received in lieu of trading receipts. So, for example, insurance monies for the loss of trading stock destroyed by fire in lieu of trading receipts, that is revenue in nature. Okay, then payments made in return for substantial restriction of one's activities. This is what we call the restrictive covenant, maybe more in individual tax, where, for example, for some companies, because of maybe the technology that is owned by the company, they may say that, this employee, when you leave the company, you cannot join a competitor for 6 months or a year, but I'll make a payment to you. I'll make this payment to you in return for not joining the competitor. So in this case, because it's to compensate for a lot of source of income for them, for the individual, so it's capital in nature. Okay, then last one is on the payments of recurrent nature, meaning that it is like not a one-time payment. It's revenue in nature. But really, I want to caution that it is not really always that conclusive. It is possible for capital receipt to be paid more than once, but we'll still look at the facts of the case. So we do not say that anything that's more than once is capped. It is revenue in nature. It's not really true in that way. Okay, so before I move on, so for the exams, right? It'll be short. There are question 1, short question answer. So like whatever that I taught just now, like I say, you don't need to quote case law. And also it's more of, I'll ask you, for example, for this receipt, taxable, not taxable, give reasons for it. Okay, so how are the points allocated? So long as you answer yes or no, taxable or not taxable, there'll be points. Okay, I mean, provided the correct answer is given. Then another point will be given on the reasons. Okay, so for example, if you really don't know, right, you don't know the reason, then at least you put like a taxable, not taxable, then you have a 50% chance of still maybe earning a point. Okay, so yeah, so this is what may be tested in the exam. I mean, definitely there'll be questions on whether receipts they are taxable or not taxable or not. So right, yes or no, or taxable, not taxable, then what is the reason? So for income, right, we are looking at Section 10 of the Income Tax Act. It is what we call the charging section. Okay, so for all income falling within the charging section of the Income Tax Act is subject to tax, unless it is specifically exempted from tax under Section 13. So Section 10 generally tells you what is taxable, Section 13 tells you what is exempted. Okay, so what is under Section 10(1)? Okay, these are the sources of income chargeable to tax. Okay, so for Section 10(1)(a), gains and profits from trade, business, profession, or vocation. This is, I mean, if you're looking at corporate tax, this is where your trade income will be taxed under. Okay, so then 10(1)(b) will be gains and profits from employment. That will be the individual side. But for a company, right, which you will also see it in your tax com, things like that. A company can also be receiving dividends. So under the D, right, dividends, interest, discount. Company may also be receiving rent under F, rents, royalties, and other profits from the property. So for dividends, interest, will be covering them later. So for rents, we are looking at, for example, like you rent out a property. The company may actually own a property that's for investment, to get rental income. So if it is rental income, we are really looking at where is that source of income. Okay, so for Singapore, we are looking at if the property is located in Singapore, that rental income is sourced in Singapore, it's brought to tax, it's taxable. But if let's say it is in a property that's overseas, okay, overseas, we do not tax the rental income overseas. It's not sourced in Singapore. But later on, you will see that under another section, we are saying that if that rental income is actually remitted brought back to Singapore, we actually bring it to tax. Okay, so for rent, we are looking at where it is sourced. In Singapore, we tax. Overseas, we don't tax. It's only taxable when it is brought to Singapore. Okay, all these like rental, dividends, interest, these are quite common type of income that you see for a company. So you may also see them in your tax form. Okay, so our focus here, like I say, will be more on 1A, D, F. Okay. Okay, so for 1A, okay, again, the Income Tax Act does not define what is trade, business, professional, vocation. But we will need to know whether a trade exists. In a sense, because generally, I mean, not just restricted corporate tax. If we are looking at general income tax, not only a person carrying on a trade, business, or profession may qualify for capital allowances. Capital allowances will help you reduce your taxable income. Okay, and it's only when a person is carrying on a trade, right? Then only the unresolved losses from the source accessible under 1A, that's a trade, can be carried forward or carried back, okay, unless it is specifically prohibited. I think in most cases, you wouldn't have an issue of whether a person is carrying on a trade or not. Okay, I said most cases, right? But it could be that for companies, what can happen is that they may be, okay, like this badges of trade thing applies to individual companies too. So it could be that at certain cases, we are not really sure whether a trade exists for that transaction, because if we consider it to be that there's a trade, right, there will be income in nature. But if it's not a trade, then capital in nature, then not taxable. Okay, so these badges of trade that you can see here, we have like 10 factors. Okay, these badges of trade, they will help us determine whether there's existence of trade. Okay, so we look at these factors in turn. Okay, so okay, these are when we see a specific case, we have to look at the facts. Then we apply all these factors on the facts, and then see whether at the end we decide whether this is that a trade. Okay. So number one that we look at is, what is the thing that we're looking at? The subject matter of realization. What's the nature of the asset? Is the asset the usual subject of trading? Okay, we may also look at what is the quantity bought. Is it then from there maybe you can see whether it's for personal use or used as a trading stock. Okay, there's actually a case law. Okay, if I ask you toilet roll. Okay, for toilet roll, do you think if I sell a toilet roll, is it for trade? Okay, there's a case law where this person bought 1 million rolls of toilet roll. Okay, so he is arguing to say that actually it's not for trade, although I sell, I want it to be for personal use. It's not for, but somehow I know I sell some toilet rolls then, but it's not a trade. I'm not running a trade on selling of toilet rolls. So the case law, right, the judge actually look at it and say, actually we are looking at 1 million rolls here, I don't really know whether in your lifetime, if you're saying it's for personal use, I don't think you can use 1 million toilet rolls. So it's more likely that it is used as a trading stock. The toilet rolls are meant to be, sold to derive income. Okay, so first you look at what is the subject matter of realization. First, property is also can be ambiguous, right? Property unit. It can be for personal use, for it to stay in, or it could be for investment, possible. Even though you don't stay there, you could rent it out. So like say rental income, is taxable, but when you sell the property, you derive gain. Is it taxable? Okay, but if you are in the business of developing property units, then when you buy and sell all these units, then yeah, it will be revenue in nature. So we'll look at the nature of the asset, the quantity bought. Then we also look at the length of period of ownership. So generally, right, the longer that the asset is being held by the company or the person, the more likely that it is capital. Because meaning that you don't really intend to sell it, to part with it. Because you are doing a trade, you need to part with it and things like that. But the thing is that how long is long? Okay. And for different type of asset, right, that definition of long can also be very different. If I'm looking at shares, for example, the shares of company, if I hold for 5 years, maybe it's really considered quite long, right? As compared to if I hold a property for 5 years, that may not be considered as long. Okay, so all this, it really depends also on the type of asset. And then, but general rule is that the longer you hold, the more likely it will be capital nature. Okay, then for item 3, we are looking at the frequency. How often does the person conduct this transaction, buy, sell transaction? So generally, it will be the more transactions we see, okay, then the more likely that it is a trade, as compared to if it is just one transaction. More difficult to say that it is a trade. Not to say impossible, but more difficult. Okay, then moving on, item 4, we are looking at whether any supplementary work has been done on that property. Okay, supplementary to make it more marketable, perhaps. So, for example, sometimes I may have a big consignment of a certain product. I may, make it in smaller packages so that I can, so it's easier to sell. Or in your textbook, you see this example of, they actually blend the whiskey, like maybe they add different things so they have different tastes to make it more marketable. Okay, so there's this supplementary work that's being done. Okay, and then number 5, we are looking at the circumstances that's responsible for realization, that's parting with the asset. So what are the circumstances? So for example, if I actually engage an agent to say I want to sell this property, or I put up a advertisement or in website or newspapers to say, hey, I want to sell this thing. So there'll be like you are taking a more proactive approach. Okay, so it will sort of indicative that you are looking at trading. But it could be some circumstances where actually, for example, I just hold on to a property, happily, maybe doing some or not doing anything with the property. Then suddenly a third party just come and say, hey, do you want to sell your property or not? I have like interested buyers to buy over this property. So I did not initiate it, okay, but it's a push by third party. So if I'm selling the property because of this, then it may be more prone to saying that it is not a trade. Okay. Then moving on to item 6, motive. Is there a profit-seeking motive? So basically, we are looking at when the company or person, when the company buys the asset, right? What is the motive behind it? Does the company intend it to be for investment? Okay, or they really decide upfront that they want to buy and sell? Okay, so sometimes for companies, the motive, it may be stated in their AGM. Okay, but sometimes it's always not so clear. Okay, to some people, they are thinking that, I've all these factors here. What is the factor that can really show that whether a person is angry, whether there's a trait or not? I look at the motive. Okay, but really motive can be hard to prove. Because if we are looking at, okay, I'm from IRIS, so if I'm looking at controller side, I don't know what documents the company have. So it's only based on what they show me. Okay, so there can be asymmetric information. But really, profit-seeking motive, I would say it holds a higher weightage if there is evidence of such that we can find. Okay, then number 7, we are looking at the way in which the asset is acquired. Okay, so if it is by gift or inheritance, then it's harder to prove that it is trading. Like I said, the badges of trade can also be applied to individual. So if it is something that I received from inheritance, then I didn't do anything with it, then someone approached me to say whether I want to sell the property, so then it'll be harder to prove that it is trade, for example. Then for number 8, whether the person already has a trading interest in the same field. Okay, so if the transaction is related to the person's trade, he has knowledge on the industry, really doing similar trade, then higher chances of saying that inclined towards that there's a trade. Okay, number 9, the method of finance. Okay, how do you finance the purchase of that property or the asset lah? So for example, from practical experience, companies, they will say that, oh, I buy that property is for investment. Of course, they want to say that, right? So when they sell the property, the receipt is considered to be capital in nature, then IRS won't tax it. Okay, so for example, if they say that it's for investment, then I will look at, for example, okay, so how do you buy that property? Okay, so there could be companies that are cash rich, so they use cash, or they could take up a loan with the company, with the bank, and buy that property. So if it's like cash rich one, okay lah. If they say it's for long term, meaning I don't intend to sell it soon. Okay, then the company has the financial means to hold on to that property. But if I'm looking at a company that is like $2 setup, and then they take up a loan with very high interest rates, I wouldn't believe that. It's more difficult for me to believe that it's for investment. More likely, they are thinking of quickly flipping the property, very short holding period, then quickly sell it, pay back the loan. Okay, so these are also what we'll look at, the method of financing. And then the last factor, we are looking at the definition of the sales proceeds. Is it plowback? They buy, sell, put the money, the sale receipts, they put it back and then buy property again, for example, shares and things like that. So these are the 10 factors that we look at. Okay, although here I say 10, sometimes if you look at other books, right, they say 7 and things like that, depending. But what I want to say is that a lot of things you have to look at the facts of the case. In different cases, okay, these badges of trade is quite gray. If let's say there's really such a case. Even if you go to the court, right, different court, when you go to different levels of court, they may have different views, even though they are presented with the same facts. Okay, it could be that sometimes a judge may place, let's say, a greater emphasis on motive, on, let's say, finance, the method of finance. Maybe another judge will place more emphasis on method of the period of ownership. So the bit can be quite gray lah. And if you ask me 100, okay, what is the weightage? It's like 10 factors. Does it mean that I look at 10% for item 1, 10% for item 2? Not really. Some are really depending on the case, sometimes it's also like not that important. Okay, so what I can see is that at the end of the day, is look at the badges of look at all the facts, but possible for different people to have different. Okay, then comes to exam. Okay, I won't be testing you or like for you to apply all the badges of trade type of question. Okay, but if you look at your case study question 1, right? Your case study question 1, you will see that part 1 is a question on badges of trade. If you're interested, you can take a look at it and you know, just I won't be going through this. Like I say, it can be way, but I think the question here is quite clear cut one. So at your own time, you can take a look at it. Okay, so we're going to do a quiz. Sorry, a poll. Then we'll see. Okay, so in this case, right, the gain is whether the gain is taxable or not. Company A has investment property. Okay, they say that it's an investment property, and they say that due to the high cost of maintaining the property, they decided to sell the property. Okay, the company has actually held the property for 15 years before the sale, and this is the company's first sale of the property. Okay, so in this case, what's your view? Do you think it is taxable or not taxable? Okay, our info share result. Okay, so 88% of you think that it's not taxable, 12% think that it's taxable. Okay, so actually in this case, it is quite it's structured in a more straightforward case lah, and the answer is that it is not taxable. Okay. Why is it not taxable? So if I apply the badges of trade, investment property, if I take as what the company is saying, so they are saying that what is the profit motive? What's the motive? It's not profit. It's not to sell, buy, sell. It's more to hold it as an investment. Okay, then what is the reason for sale? The company is saying that it is because of the high maintenance. Okay. So they decide to sell. Okay, then what is the period of ownership? 15 years. Whether you consider that as long. Okay, then if I look at the frequency of transaction, this is the first transaction. So let's say these are the facts that we have, and we are able to have documentation to support, the company is able to produce documentation to support all this. Then I would say on the balance, I'll be inclined to treat it as not taxable. The company is not doing a trade on the sale of property. Okay, so this is how we apply the badges of trade. But like I say, okay, if it will be tested in the exam to be something that is quite clear cut, you don't need to like go through the whole list of like 10 factors and things like that. It should be something that is very clear cut. Okay, then there's this question, I think whether if the property is only held for 2 years, will it change whether it becomes taxable? This is a good question. So, okay. So there can be a lot of permutation. Like I say, we have to look at the tax matrix. Even if I say something, then maybe another person would feel it differently. So I just take the first part saying that if let's say the property is only held for 2 years. Okay, so if it's held for 2 years, let's say all the facts is still the same, held for 2 years, then I will need to look at the circumstances of why they are selling it. Then maybe these facts are not enough. Like this is like a simple poll question. Really, I will go through the full badges of trade. How do you finance? How do you finance it? What are the if you are thinking that it's for investment, is there anything that can show that it's for investment instead of maybe in your AGM, do you have anything else? I also look at the other information that I will ask, okay, and then determine it. But in case you're, like I think it can be gray because the property wise a bit can be a bit gray if you're looking at property unit. So I don't think I can give a definite answer for it because I will definitely ask the person, to give me more info on that. Okay, I can see that there are some questions, but really, it really depends on the factor matrix. Okay, you all don't pose question. I'm not going to answer what if this, what if that. Okay, so usually for companies, sometimes what companies may do is that they may, if it's a very big amount, they may actually, of course, engage their tax agent to look through it. They will show to IRS, state to IRS why of course the company doesn't want the gain to be taxed, right? The company would list out like the tax agents or the companies will usually go through the badges of trade and then explain for each item why they think that what are the facts, and then come to a conclusion. Of course, in most circumstances, they will list out whatever is favorable to them. So it's for, let's say for IRS, they will may dig some more to look at various documents to see whether that is really the case. Okay, but if I ask you a question, if let's say individual actually bought a few properties, buy, sell, and then the person is saying that, the reason why I sell the property is because of bad feng shui. Okay, bad feng shui, because after living there, I realized like not very good. So I have to sell the property. Then I have to buy a new property to stay, right? Then maybe later on, maybe still like, don't feel very well, then I sell it. So what do you think? Do you think like bad feng shui is a valid reason for this buy sell? This anyway, just for information, there's really a case that went to court. It's an individual case, and then the factor that's quoted by the individual is bad feng shui. Okay. So I think buy sell a few properties. So for me personally, when I look at it, I thought like this, how can bad feng shui be a factor? But you'll be quite interesting. I think you can just Google lah. You should be able to find the case law on that. I think for one of the property, because of various factors, it is really viewed as that the gain is not taxable. Okay, I won't be covering it as an individual case, but quite interesting. Like I say, a bit sometimes quite gray lah. A bit difficult to say. Definitely this is taxable, this is not taxable. Although really from the company's point of view, they will want it to be not taxable. They will put all the things to say that it is not taxable tax. Then controller, they will try to propose and see whether, based on the fact, can we believe the taxpayer, or you drill down more, ask for more information, it may turn out to be otherwise. Like I said, sometimes there can be asymmetric of information. So it's more of after drilling a few times, we look at other documents may show that this is not what the taxpayer has said. Yeah. So okay, so that, which is why for my part, I won't ask questions on badges of trade where you have to apply all these so many factors and say lah. But of course, in real life, or let's say in maybe the higher level corporate tax, they will ask you all, then you apply. Then I think it's more of how you argue out your case. It's more of how you argue out your case, whether you look at the right factors. But really, sometimes it's not so easy. In this way. Okay, any questions? Okay, if not, okay. Anyway, later on at the end of session 2, if you have any other questions, you want to talk about the topics that we covered earlier, you can still, bring them up. Okay, which is why, yeah, I hope that we restrict to your questions to this content here, then we can discuss them. Although I may not be able to give you an answer, okay, because I think in real life, also no definite answer for the badges of trade. But if other things that you are not clear, I will try my best to answer them. Okay. Okay, so we have covered the part on income. Okay, so income part is whether it's taxable. Okay, so whether it's capital in nature, whether it's revenue in nature. Capital, we don't have capital gains tax, so not taxable. Revenue in nature, yes. So how do you look at whether it's capital or revenue? We apply the test. Okay, so that is it circulating capital, whether it's fixed capital. Okay. Now we are coming to the other part, which is on deductions. Okay, for deductions, this is just a overview. So for deductions, we are looking at section 14, section 15. Okay, so for section 14, it's more on the type of deductions that are allowable. Okay, section 15, it tells you what is not allowable. Okay, so expenses, we are looking at whether it is deductible, not deductible. The income, we are looking at whether it's taxable, not taxable. Okay, so if I look at the tax computation, so you apply the rules that we will cover later on. So for tax computation, what you need to do is that, okay, if a deduction is not allowable, we have to add back into the tax comp. Right, so we need to make adjustments. Okay, but if let's say it is amount that is deductible, because it will have already shown reflected in order to derive at the net profit, right? Then you may not need to make adjustments. I say may not, because maybe sometimes under the Income Tax Act, although you have incurred the expense, we may not allow that 100% to you. We could, let's say, limit to 50%, depending. Or the Act would say that instead of 100%, you can claim 200%. Okay, so that's when you have to make adjustments too, even if the amount is deductible. Okay, so for expense, again, there's the capital revenue divide, just like income. Okay, so if you look at some of the factors, one will be, all these are also from case laws. So for these factors, once and for all, a capital expenditure is a thing that is going to be spent once and for all. Okay, and income expenditure is something that's going to recur every year. This is a very broad level one, not always correct in a way. Okay, so sometimes income, revenue expense, maybe you only incur once, maybe that's possible. Okay. But one that is, we will look at it is whether there's an enduring benefit of trade. Okay, if the expense that you incurred brings about an enduring benefit of trade, right? Then it is a capital expense. Capital in nature. Okay, so if capital in nature for income tax wise, we don't allow a deduction. Okay, but depending, we may allow maybe capital allowance. Okay, may or may not, depending that asset that we are looking at. Okay, so in this case, most companies will want to argue that maybe it's more revenue in nature, but it depends. Under certain circumstances, even though it's a capital expense in certain part of the act, it may be favorable also that the company can claim the deduction. Then we look at, again, we apply the fixed versus circulating capital test. Okay, so fixed capital is something that you keep in order to make a profit. Okay, so if you incur the expense, you buy, let's say you buy a machine, you use the machine for your trade. Okay, so the expense is capital expense, you cannot claim the expense. Okay, so more or less the same thing. All these, they are from case laws, which you can actually see them in your, read about them in your textbook if you want to. Okay, so for capital, usually we are saying that it is once and for all, non-recurring. It is to acquire an enduring benefit. Okay, if it's revenue in nature, it's recurrence operational. Okay, what are the general tests? I keep repeating myself, but I've already gone through this. So in the exams, there will also be a question on whether an expense is deductible or not. Short question answer. So you'll be like, for example, you'll tell me deductible, then or not deductible, then I give you 0.5 marks. Then it will, definitely will ask you so what is the reason for saying that it is deductible or non-deductible? Then you state your reason. Like I say, even if you don't know the reason, you just hazard a guess. Maybe you can still get points for that. Okay. But like I said, specific points one is tax treatment, the other point is on reason. So make sure you answer, you don't just give reason, you still have to state whether it's deductible or not deductible. Okay. Okay, these are non-conclusive factors, but sometimes that we'll see, when people want to say what is the nature, they may bring all this up, but they are actually not very conclusive. One is whether it's a lump sum incurred one time or their periodic payment. Okay, then there'll be the magnitude of the expenditure. Really, amount is usually, some people may say because it's a big amount, it's capital in nature. Not really true also. Okay. Then the capital receipt does not spell capital disbursement. What it is trying to say is that the tax treatment, when a person who okay, in this case, right, person who sells the car, okay, because the car is the company's fixed asset, they may say that this is a capital receipt. Okay, but the person who bought over the car is one that runs the second-hand car dealership, right? For this person, because we look at the business of that person. In this case, it can be viewed, this is a revenue expense because it's part of the inventory. Okay, so what this is trying to say is that the buyer and seller, we don't look at the treatment. We look at for that specific person, for the transaction, look at the facts, then to determine the treatment. Okay, then the payment out of capital, purchasing trading stock, using proceeds of sale of shares, does not convert the expenditure into one that's capital in nature. So I don't really look at where is your source of that fund. Because if you use to buy trading stocks, right, regardless of your source of funds, the trading stock is part of your inventory that you need to buy and sell. The expense that you go and buy the trading stock, that will be a revenue expense. Accounting entries, you can always see people quote this to if it's favorable to them, they will quote for example, oh, you see this, I have this under fixed asset or I do this under revenue expense and things like that. But these are not conclusive. Okay, so the governing sections, right? Just already say, right, for section 14. So the section 14 will actually list out the rules on what are the expenses that are deductible. Okay, then even for certain types that you look at it, maybe capital in nature, maybe, or it's not revenue in nature, but because some part of section 14 states that it is deductible, then it's deductible. I know sometimes people say, for income tax, are there principle or not? Just now I mentioned the broad principle, if it's a capital receipt, then generally not deductible. But really, at the end of the day, we look at what is provided for in the Act. Okay, capital receipt, yes, generally not deductible, but if it is provided for in the Act to say that you can claim a deduction, then you claim a deduction. It could be because of policy reasons. They want to encourage certain form of activities, then they allow an expenditure. Or some, it could be no revenue expense, but because they want to discourage certain activities, like later on you will see like motor car vehicles, they want to discourage having too many cars on the road. So they say you cannot claim expense. So yeah, so where it is stated clearly in the Act, then we just follow the tax treatment. It's only for those that are not stated clearly one, then you may have to argue whether, again, on the revenue capital divide. Okay, so for section 14.1, we are looking at, so it's on deduction, right? What can be deducted? There are things, okay, this is what is stated in section 14.1. To ascertain the income, this can be deducted, that these expenses must be wholly and exclusively incurred during that period and in the production of the income. Okay, so if we break them down, you see ascertaining the income that's chargeable to tax. So one thing for the expense to be deductible, a general one, let's say it's not stated anywhere on specific tax treatment. So the expense must be incurred to earn income that is chargeable to tax. Okay, so for example, for dividend income, okay, so for dividend income, right, later we'll cover them later, but let's say just a quick example. So for dividend income, it is if the dividends are actually paid out by a Singapore resident company, that dividend income is not subject to tax, it's exempted from tax. So if let's say the company, I borrow money to buy the share counters, and so I incur interest expense. But because this dividend income is not subject to tax, okay, it's not subject to tax, it's not chargeable, income chargeable to tax, then in this case, the expenses that is related to this income is also not deductible. Okay, so then in this example that you see, where expenses is incurred to derive foreign income. Okay, for foreign source income, we are looking at, if the foreign source income is remitted, then we'll bring it to tax. Okay, so if it is not remitted yet, then the expenses is not deductible. Okay, so we need to look at when we have an expense, what is it incurred for? Okay, then the income, it must be an income that's chargeable to tax. Okay, so the item of deduction expenditure, we're also looking at it must be incurred during the basis period for the YA concern, wholly and exclusively incurred in the production of the income. When we are talking about incurred, right, it doesn't mean that it has to be paid in cash. I mean, it doesn't need to be paid. So it can be deductible if the liability has crystallized both in law and in quantum. So it cannot be something that is a contingent liability or general provision where it has not been crystallized. So, for example, if let's say in the course of business, I buy goods from another party, then when I receive the goods, right, the seller will actually issue me with an invoice. The invoice will actually state what is the amount that you have to pay by which date. So for example, if let's say I receive the goods and the invoice was issued to me on, let's say, 28 December. Let's say I have a financial year end ending December. So I was issued with the invoice. So actually the liability has really crystallized in law and quantum already. So, but maybe the seller normal credit terms to say, oh, you only need to make payment within 30 days from the date of invoice. So let's say I send a check over on 5th of January in the following year. So, but because I already, the liability has really crystallized. So what can happen is that I would claim the expenses in this YA. So for example, the date of invoice is 28 December 2021, but I make the payment in 1st Jan 2022, I will claim these expenses for YA 2022. Okay, because liability has really crystallized in year 2021, let's say December year end. Okay. Then there are those where companies just do like general provisions. No, we don't allow. Okay, this may be allowed under accounting, but not allowed, not deductible for income tax. Okay, then the other thing that you will see very often in tax com in the P&L will be the depreciation. So depreciation is just a book accounting entry. Okay, so it's not really incurred. So for income tax wise, for depreciation, we would disallow. Okay, because it does not meet this rule. Okay, wholly and exclusively. Okay, we are looking at wholly, meaning the quantum. Everything, full amount must be incurred. Exclusively, we are looking at the motive. Okay, so what is the reason for incurring that? Okay, so although we say wholly, right, must be 100%, but actually in practice, we don't. Even if part of it is for that, even though there's duality of purpose, but we will still allow for income tax. It may not need to be 100%. Okay, the motive part is arguable, so we'll look at that. Okay, in the production of income, here there must be a close connection between the expenditure incurred and the income producing activity. It does not mean that you have to produce income in the year. Okay, so again, we have to relate back to what is that income that we are looking at that you incur the expenditure. Okay, so this is the general deduction formula. I run through the few factors. We are going to take a break here, and then we'll go into the specific items under section 14.1. Okay, so now it's 11:15. We are going to take a 10-minute break. Okay, so I'll see you back at 11:25. Okay, see you. Back from your break. So, okay, we'll move on to specific deductions under section 14.1. Okay, this section 14.1a part 1 is very common. We can allow a deduction that is incurred on capital employed in acquiring income chargeable to tax. Okay, so the thing here is that it is incurred on capital. This interest income. So usually there is likely to be a loan. Okay, so the loan is taken out to buy a capital as used to acquire income. And the income must be chargeable to tax. Okay, so in the example that we have here is that we have interest that's paid on a loan obtained to finance the purchase of factory building that is used for income producing activities. Okay, because that factory building is a capital, okay, it's used to produce maybe certain goods, certain products. So it's an income for income producing activities. So the loan, we're taking out a loan, the interest on the loan is deductible. Okay, versus the repayment of the loan itself. Okay, the repayment of the loan itself, it is actually capital in nature because we are buying a capital asset, right? Capital in nature. So for that payment of that loan, the repayment of that loan, that is not deductible. And later on, we will see this being reflected under section 15. But here I just want to just highlight. Here we are looking at the interest component. Okay. Then under the next item, we have qualifying borrowing costs. They are actually incurred as a substitute for interest expense or to reduce the interest cost incurred on the income chargeable to tax. So an example is the guarantee fees paid to the guarantor so that the borrower can enjoy preferential interest rates and reduce its interest cost. Okay. 41B, rent, the rental expense that you incur. It is deductible if it is paid in respect of any land or building or any part of the building that is for acquiring income chargeable tax. Okay, but even say the property part, only part of it is used for the income producing activities, right? Then we may need to apportion it. Yeah, example of the rent would be, for example, rental of paid for an office or factory. Okay, then 14.1c, repairs and renewals. Okay, these are actually incurred for repair of premises, plants, and machinery for fixture employed in acquiring income chargeable tax or for the renewal of any implement, utensil, article that is being used. Okay, so things to note is that we are looking at repairs. So this is something that if it is to put something back to its original condition, so it's a repair. If there's an improvement, then we cannot allow the deduction. Okay. And this thing on renewals of any implement, utensil, article, these are usually things that are very small items. Okay, so after you buy them, then you need to renew it because they've been spoiled in normal course of usage. Then you can actually claim that under section 14.1c. Okay, so for larger items, right? Larger items, generally, they may be able to qualify for capital allowance under section 19 or section 19A. In this case, we will not be allowing a deduction on that. Okay, so for reconstruction costs, rebuilding, this is not putting the thing back to its original condition. So we also not allow a deduction under 14C. So I think it will not qualify for deduction under section 14(1)(c). Okay, next we move on to bad and doubtful debts. Okay, bad debt is actually incurred in any trade, business, or profession. They have become bad during the period for which the income is ascertained. So doubtful debts, they are like ascertained to become bad. So one example would be, for example, you sell to this company on credit terms, then the company has gone bankrupt, liquidation. Okay, so you will not be able to recover the debts. Okay, so in this case, you can actually claim an expense on the debt that has gone bad. Okay, but with conditions now. One is that the amount, right, must have been treated as a trading receipt in the first place. So let's say you are in a business of buying, trading in certain goods, right? So you sell to this person. So this, when you make the sale, they will have been accounted for as trading receipts, as income to you. Okay, so later on, let's say you are not able to recover after like taking some enforcement action, like asking your lawyers to write letters, ask someone to go after the debts, are not able to recover and becomes bad, then you can claim expense, provided that that amount has been treated as a trading receipt before. But let's say for some reason you're able to recover this debt, then what the amount that you actually recover, you have to bring it back to tax as a trading receipt. Okay, I hope that this is clear. Then we have impairment loss on trade debt. Is allowable, okay, under 14(1)(d), but here the thing is that it must be a trade debt, meaning it's revenue in nature. Okay, so if you look at under FRS 109, right, we will allow trade debts if it is credit impaired. Okay, so again, similarly, if we are able to recover these trade debts, the reversal, it must be brought to tax. Okay, for non-credit impaired trade debts, they are not deductible. As to what is credit impaired, what is not credit impaired, you have to look at the accounting rules. They will have some requirements to see, say, when you will consider as credit impaired. Okay, so anyway, if it is for the purpose of exam, I can't remember if we have a question that we won't ask you like you have to tell me what is credit impaired, what is not credit impaired. And things, if any, will be quite clear to you. For example, whether it is credit impaired. Then we have contributions to pension or provident funds under section 14(1)(e). It is deductible if the fund is a full pension fund or provident fund or pension or provident fund constituted outside Singapore, and the sum contributed by the employer in respect of any employees are mandatory. For example, your CPF contributions. Okay, so here the thing is that it must be a full pension fund. Okay, and the thing is that even for CPF, this must be mandatory contributions. So for example, if actually CPF, we don't contribute for employees holding professional visit pass or work pass. So if somehow you manage to do a contribution, that contribution is not deductible. Then we have contributions to MediSave account. Okay, it is deductible. The employer's contributions to MediSave account is deductible. Okay, up to a certain amount. Okay, so for each employee, it's actually $2,730 and within the CPF annual limit. So meaning that these are actually mandatory contributions. Okay. Then we have deduction on zakat deductible. Actually, this may be more applicable for individual tax. This is some fees that the Muslims may have to pay. Okay, so the thing is that for this zakat, sometimes we may have the misconception that it is a donation, but really it is not a donation, it's really a deduction. Okay, then we'll move on to medical expense restriction. I would say it is important for the exam because definitely in your tax com, you will see this in the tax com that you have to do and you have to show working. Okay, so for medical expense restriction, I say important, okay, in case you didn't catch it. So actually medical expense it is deductible. Okay, the question, but the problem is that not the full amount, the full amount may not be deductible. Okay, so this is actually provided for under section 14(5) to 8. So, okay, I think we have to first ascertain what are medical expense. So medical expense include, so these are actually paid by the employer. So we have your maternity, healthcare, your medical care, preventive and therapeutic treatment expense, provision of a medical clinic by the employer, the cash allowance in lieu of medical expenses, your dental expenses, then also your medical insurance premium. Okay, and then the contributions to employees' MediSave account. So all these things are considered as medical expenses incurred by the employer. Okay, so meaning that there's a possibility that when I add up all these things, not everything can be deducted. Okay, so the deductible amount is actually capped at either 1% or 2% of the total employee remuneration. Okay, why 1%, 2% later we see, okay, which is applicable, but we have to look at what is the total employees remuneration. Okay, this will include your normal type, like your employee salaries, allowance, bonuses, your director's remuneration, your CPF contributions. Okay, what will not be included as employee remuneration will be your director's fees, your medical expenses, your cash allowance in lieu of medical expenses, benefits in kind, skills development levy, foreign worker levy. Okay, so this would mean that the larger my employee remuneration, whether I apply 1% or 2% cap, then the larger medical amount of medical expense I can claim. Okay, like I say, so 1% or 2%, it really depends. Okay, so it will be 2%, meaning I can allow a higher amount. Okay, if the company implements the portable medical benefit scheme or the transferable medical insurance scheme or inpatient medical expense benefits in the form of portable medical shield plans or ad hoc contributions to employees' MediSave account up to the cap. So if the company actually implements any of these schemes, they can claim 2% of the total remuneration, employees' remuneration, and that is the amount that the medical expense that can claim. Otherwise, it'll be 1% of total employees' remuneration. Okay, maybe I show this example first, just to elaborate what I was talking about. So let's say the total medical expense is actually $6,000. So I add up whatever, like dental expense, medical expense, medical insurance and things like that, add that up. Then I look at my total remuneration, my employee salary, CPF contribution, etc. Add them up. Okay, so assuming if I didn't say anything, I take it that the company didn't implement any of the schemes. So I'll apply a cap 1%. Okay, so I'll do 1% times the total remuneration. Okay, so meaning that the max that I can allow for medical expense is 5,000. Okay, so in this case, right, my total medical expense is 6,000. Okay, so in my account I already state 6,000, right? So, but I can only allow 5,000. I have to, in my tax form, I have to add back that this 1,000 is not deductible. Right, so this is the amount to be disallowed. Okay, but if let's say my medical expense is only $4,000, so I have not reached the cap of 5,000 yet, so I can claim the full $4,000. Then I don't need to make any adjustment. Okay, so the adjustment to the tax form. Okay, if I didn't hit the cap, then I can claim the full medical expense. If I hit the cap, right, only the amount in excess will be added back. Okay, so in this example, the amount in excess is that $1,000. Okay, I'm not going to tax the full medical expense. I'm only going to add back the excess amount. Okay, I hope that this is clear. Okay, then for specific deduction provisions, you can see here, just now I'm talking about 14.1, small a, small b, and things like that. Here we are looking at section 14, capital A, okay, to capital Z. Okay, these are the provisions that specifically allow tax deduction of expenditure that do not satisfy the general deduction formula, or it could be that I can give, instead of 100% deduction, I'm giving 200% deduction. Okay, these are provided here. Okay, these are enacted to advance certain policy objectives. Okay, so we can see A to Z, right? I won't be covering all. Okay, I will just be covering the two which are more common type, and they will be tested in the exam. I mean, because it's in a tax com, you have to know them in order to do a tax com. Okay, so we look at section 14N. That's a deduction on R&R cost, the renovation and refurbishment. Okay, so what is this about? Okay, it's a tax deduction for expenses incurred on renovation or refurbishment works done to the business premise. That renovation or refurbishment, I just call R&R in short. So the thing here is that it is incurred on that business premise. Okay, versus if let's say I'm a company, I actually have a property that I let my employees stay there. That is not considered as a business premise. So if I do any work on that, it's not deductible. So usually these are things that we look at with what you use for your office. If you're retail, it'll be your shop. Okay. And this is for a person who is carrying on a trade, business, or profession. Okay. And we have a cap. It's a qualifying expenditure capped at 300,000 for every relevant 3-year period. Okay, so the cap is across 3 years. Okay, cap is at 300,000. Later we'll look at examples, but this is what it's about. This qualifying expenditure is what you incur. Okay, but what is it that is deductible? Okay, if you look at the last column, we have tax deduction is given over a period of 3 consecutive years. Okay, starting from the YA, the R&R cost was first incurred and claimed. Okay, so the thing is that 3 consecutive, meaning there cannot be a break in between. And later we see some more examples. Then it's on straight line basis, meaning that you have to, whatever that is allowable, then you divide by 3. Okay. And the claim cannot be deferred, meaning in the year that I've incurred the expense, I have to file a claim already. If I didn't file a claim, sorry, it's gone. Okay, you will not be able to file a claim for the subsequent YA. Okay, so for the 3 consecutive years, that one, you see that there's asterisk, right? So if you look at the blue box below, okay, so for YA 2021 and YA 2022, okay, 2022, so our exam question is YA 2022. Okay, the taxpayer will be given irrevocable option to claim the qualifying cost in 1 year instead of over 3 years. Okay, so instead of like the deduction divided by 3 spread over 3 years, they can claim in just 1 year. And for ease, I would call this accelerated R&R deduction. So over 3 years, one is the normal deduction. Okay, so in the exam question, if you are saying that the taxpayer wants to accelerate the claim, then meaning that it will be for 1 year instead of the 3 years. Okay, so there's this question, so there's this thing, qualifying R&R, it must be, the expenditure must be in terms of something that's qualifying. Okay, so what is qualifying? Okay, this will include expenditure on fixtures, fittings for renovation or refurbishment work done on the business expense. So we have the examples here. I would say for exams, you just remember all these examples. Okay, because if you need, then you don't have to like scratch your head and wonder whether it is a qualifying or not. Okay, it's easier for you to just remember and apply because you really don't have much time. Okay, so what are the examples of qualifying R&R? Okay, I have the general electrical installation, like your wiring and things like that. Your general lighting, okay, your hot and cold water systems, your kitchen fittings, sanitary fittings, that's in the toilet, have door, gate, roller shutters, fixed partition. This fixed partition, meaning cannot move one. Later you will see in our capital allowance, we allow for those that are not fixed. Okay, so there's a difference. Okay, fixed partition. Then we have flooring, false ceiling, and cornices. We have fitting rooms in retail outlets, and we have hacking work in premises and also hoarding work. So these are examples of qualifying R&R. Okay, so when we have something that's qualifying, there's this part of non-qualifying. Okay, non-qualifying R&R, this will mean that even if you incur costs, generally you call them as renovation costs, Okay, incur costs on that, you cannot count them towards your qualifying expenditure for that $300,000. Okay, non-qualifying R&R. Okay, so you also just remember them So for R&R works which require the approval of the Commissioner of Building Control, your designer of professional fees, antique, any fine art, also works carried out on the place of residence provided to employees. Okay, and those R&R costs that qualify as capital expenditure, where you can claim capital allowance. I mean, you can see why we don't want to allow a double deduction. Okay, so these are non-qualifying R&R. Okay, so how does this thing work? I think for those who do corporate tax, then it's easy but in case for those who doesn't, this can be a bit complicated. So we are looking at qualifying expenditure cap at 300,000 for every relevant 3-year period. Okay, so even though just now I said that you can maximize your claim and do the accelerated thing, right? That is for deduction. For this, if you're looking at whether it's qualifying expenditure or not, right? Then you have to apply this, still have to apply this 3-year relevant period. Okay, so in this example, I have YA 20, 20, 21, 22. Okay, so total qualifying R&R, meaning that this is in the list of that. Actually, there's like, we tell people what is non-qualifying R&R, but the rest is generally those examples that you see there. So assuming I already ascertain this is not R&R that requires the Commissioner of Buildings approval type. So let's say it's general lighting and things like that. So I already ascertain that these are qualifying R&R. Okay, then let's say in YA 2020, I have incurred 150,000, YA 2021, 30,000, YA 2022, 300,000. Okay, although these are qualifying, but remember we have cap of 300,000 over 3 years. So in first year, okay, 150,000 still below the 300,000 cap, right? I can accept this as a qualifying expenditure. Okay, then comes to YA 2021, 30,000. Okay, I still have not hit the 300,000 cap yet. But when I come to YA 2022, okay, I cannot allow the full 300,000 because if I do my sums, right, the max that I can allow is only up to 120,000 because when I add all this up, it will hit the 300,000 cap. Okay, so these are things that you need to take note of, even though it's qualifying, whether it hits the cap or not. Okay, so in the first year of claim, right, is YA 2020. Then the 3-year period will be Y 2020 to Y 2022. Okay, so for the company's first claim, so I say companies first claim, when you start from a certain YA, then the clock starts from there. I always look at the blocks of 3 years from that. Okay, so the next 3-year period is YA 2023 to YA 2025. Okay, so I cannot, in a way, I cannot change this 3-year period. So even if, let's say, in YA 2023, happens to be like the back 3 years already passed, right, up to YA 2022. But let's say I didn't incur any qualifying R&R expenditure in YA 2023. Sorry, the 3-year period still starts from YA 2023. Okay, let's say I also didn't incur anything in YA 2024. Sorry, the 3-year period will still end in YA 2025. Okay, if let's say no claim is made, in this example, YA 2020, 150,000. Okay, let's say no claim is made, right? The amount will not qualify for deduction for subsequent years. Okay, remember we said that we need to spread over 3 years, right? We don't do the spread. You didn't claim, you cannot say that I want to claim this 150,000 in YA 2021. Cannot. As a qualifying expenditure. It won't qualify, you will not qualify as qualifying expenditure in YA 2021. Okay, so if I just talk about a few permutations, because I say this one will be out in exams and this is quite common. Okay, let's say in YA 2020, I've incurred total qualifying R&R of 450,000. Okay, so in the first year, I already hit the 300,000 cap, right? So my qualifying R&R expenditure for YA 2020 will be 300,000. Okay, so for the next two YAs, regardless of how much I've incurred, it will be 0 for YA 2021, 0 for YA 2022. Okay, so this is how the cap applies. Okay, but if let's say, for some reason, I didn't claim that 150,000 in YA 20, or okay, that 300,000 in YA 2020. Okay, so I didn't claim, I cannot view it as a qualifying expenditure for YA 2021 already. But let's say YA 2021, I incurred qualifying expenditure of, let's say, 320,000. Okay, so because this 300,000 has not been used before, right, has not been utilized, so I can allow that 320 but limit to 300,000 cap amount for YA 2021. That is considered as a qualifying expenditure. Okay. So that is the expenditure part. But how much you can claim in the tax com is a different thing. Okay, that's why I say this 14N deduction can be a bit complicated. So in a normal deduction, okay, I still have to cover normal deduction and things like that because this is a normal tax com. Remember, this is an option. The taxpayer can choose to claim normal deduction or the taxpayer can choose to claim accelerated. Okay, in a normal deduction, straight line basis. So we are looking using as the same example that we've seen just now. The first table, you see what is the amount of qualifying R&R already, right? Okay. So remember, I identify what is the qualifying expenditure, but I can, for normal deduction case, I claim it over 3 years. Which is why in the second table, you can see that for the 150,000, I have to divide by 3, split it over 3 years, and claim in YA 2020 to YA 2022, 50,000 in each YA. Okay, then the same goes for that 30,000 incurred in YA 2021, I have to split it evenly across 3 YA. Okay, for YA 2022, because I already done the cap, right? So the $120,000 is a cap. Then I split it evenly over 3 YAs. But what you need to remember is that, let's say when you are preparing the tax com for YA 2022, right? You cannot just look at that $40,000. Okay, you need to take into account those deductions that you can claim over the years. I mean, incurred earlier, but you can still claim YA 2022. So in this case, you need to take into account the 50,000. You need to take into account the 10,000 plus the 40,000. This will give you that deduction of 100,000 in YA 2022. Okay, so in the table, you can also see for yourself, right? Like for YA 2021, you need to add whatever amount that is applicable. Yeah, so there's a distinction between expenditure and deduction. Okay, but for YA 2021 and YA 2022, we have the accelerated INR. Okay, so we are looking using the same example, but what is different here is that, okay, no difference for YA 2020 that 150,000, I still have to split. Now. Okay, across. Okay, for YA 2021, I have 30,000. This is for illustration. Assuming, let's say, I didn't want to use accelerated. I do the normal type. So I will still split 30,000 across the 3 YAs. But when it comes to YA 2022, somehow I decided that, oh, I want to do the accelerated. Okay, so the 120,000, I don't need to spread 40,000 over 3 YAs, but instead I can claim the full 120,000 in the YA. Okay, so this is the difference, the part that is different. So I just want to highlight to you, instead of spreading over 3 YAs, you can claim the full amount in that YA. Okay, but of course, as what I mentioned earlier, you don't just look at that year, how much I've incurred. Instead, you have to look at, are there qualifying deductions from earlier YAs? So you need to add them all together. In this case, the deduction for 14N for YA 2022 is 180,000. Okay. Okay, this one, if you are new to this 14N, you may find it to be a bit complicated, but it's important that you know, because like I say, you definitely need to do, definitely in exams, it will come out one. Okay, so as a recap, okay, what are things that we need to do? First, we determine whether it is a qualifying expenditure or not. Okay, like I say, you just look at that, then second step, after you have determined, okay, which expenditure are qualifying, then you have to apply your 3-year period, apply your 300,000 cap. Okay. After you apply that cap and work out what is the qualifying expenditure for that YA, then the third step is then you determine how much you want to pay or you can claim. Okay, so for YA 2021 and YA 2022, you can actually choose to claim over 1 year instead of 3 years. Okay, but remember the total deductions, you have to take into account what is allowable in the previous YA. Okay, so I think after talking about this, it's always better that we have hands-on. Okay, so this is the question that you have. Okay, so applicable period is YA 2020 to YA 2022. Qualifying expenditure is 150,000 for YA 2020. Okay, so in year 2020, I have renovation cost, 80,000 non-qualifying, 100,000 qualifying. And in YA 2021, I've elected to claim accelerated deduction. Okay, so I will need you to compute what is the total amount of 14N deduction that I can claim in YA 2021. Okay, so I've launched a poll. After you have worked out, done the computation, you can just indicate your selections there. We will wait for a few more responses to come in. Okay, I'll end the poll. Share results. Okay, so most of you have selected 150,000, which is the correct answer. Okay, so how do we derive the 150,000? Okay, so if we look at, okay, so we need to compute the deduction for YA 2021. Okay, so what is given here is that for in YA 2021, I think what is the figure that we need to extract? Will be the 100,000 because that's a qualifying expenditure. Okay, so it says here that for year 2021, which is that YA 2021, right? Oh, sorry, year 2020, YA 2021, accelerated deduction has been elected. Okay, so meaning that I wish to do the same 100,000. Okay, so but the thing is that I cannot just look at the current year. I need to look at the back years. I need to apply the 3 years to see whether I need to apply any cap or not. And so if I look at YA 2020, because the period, right, is YA 2020 onwards. So YA 2020 is the first year of the 3-year period. It's 150,000. Okay. If I do the 150,000 plus 100,000, okay, good. I still have not hit the 30,000 cap yet, right? So I can claim the qualifying expenditure will be 100,000 for YA 2021. Okay, but for deduction wise, okay, I cannot just look at the 100,000. I have to look at earlier YAs. So for YA 2020, okay, that is no accelerated, right? So I have to spread the 150,000 over 3 years. This means that I can claim 50,000 in YA 2020, 2021, and YA 2022. So for YA 2021, it will be 100,000 plus 50,000. That gives us 150,000. Okay, so not bad. Okay, at least most of us we can work out what is the correct amount. Okay, let us try another question. Okay, I will not read it out. I think you can just view it from your side, or just launch the poll and then try to work out and then indicate your answer. Okay. Okay, I think I will just end the poll. This one can be a bit complicated. Okay, so we have a poll. Wow, now we have more varied answers. So, okay, at least half of y'all got the answer correct. Yeah, I mean, if you have seen this for the first time, then I think it can be a bit confusing, which is why we have the poll. Then you check your understanding, you do it once, and then we'll go through the answer. Okay, so not bad. Okay, half of y'all got it. Yeah, I'm going to stop sharing the poll, and then we'll go through how we arrived at the answer of 100,000. Okay, so just now we're already. So what is new, right? The information here is that in year 2021, I've incurred total renovation cost of 30,000 non-qualifying and 80,000 qualifying. Okay, because it's year 2021, YA 2022 applies. Okay, I'm going to elect for accelerated deduction. Okay, this will mean that I don't have to spread the deduction over 3 years. Okay, so first thing, I look at what year 2021, non-qualifying of 30,000, don't need to look at that. I'll just need to look at this 80,000 of qualifying. Okay, the thing is that remember, we always have to apply the 300,000 cap. Okay, because it's still YA 2022 is still within that 3-year period, right? Okay, so if you look at YA 2020, I've already taken up 150,000. YA 2021, 100,000, so total 250,000. Okay, so what is left will be 50,000 for me to hit the 300,000 cap. Okay, so in this case, even though in YA 2022, my qualifying expenditure is 80,000, I cannot, I need to impose the cap such that the qualifying expenditure is only 50,000 for YA 2022. Okay, so for this 50,000, is accelerated deduction, meaning I can claim 50,000. Okay, but again, I cannot just look at what is incurred for YA 2022. I need to look at the deduction applicable from the previous YA too. Okay, so the thing is that for YA 2021, I already claimed the full 100%, right? So that 100,000 already claimed in YA 2021, so nothing to be claimed deductible in YA 2022. Okay, for YA 2020, the 150,000 is actually spread over 3 years, so 50,000 every YA. So for YA 2022, there's still the 50,000 from YA 20 that I can claim. Okay, so this 50,000 plus the cap of 50,000 for this YA 2022, I add them up, 50 and 50, that gives me 100,000. Is this clear? If not clear, then you unmute, then we can discuss. Anyway, I think in your textbook, probably there are some more examples on the website. Yeah, also some more examples. I think mine is more, I mean, this is the first time that you're looking at this. Probably need a clear mind because it's a bit complicated. Okay, so I move on to what are the adjustments that we need to make to the tax com. Okay, you can see for me, I'll structure the lesson in such a way that every time we go through theory, then we look at what are the adjustments to do in tax com instead of leaving it next week, then we go through the tax com. Okay, so it really depends on how the qualifying expenditure is being reflected. Okay, so if you look at the left-hand column. So, okay, if it is actually for any if you have anything that says renovation, for example, that you will just add back first. Okay, if the qualifying expenditure is reflected under expenses, I'll just add back the full amount. Okay, then I have to determine what is qualifying. Okay, then I have to apply the cap. Then I claim a deduction for that YA. So that deduction, I have to look at any amount from previous years that I can claim to. Okay, you add back first, then you determine, then you claim deduction. Okay, because this expense has already been reflected in order for you to derive at the net profit, right? So you need to add back the full amount. But sometimes, right, these expenses, it can be reflected not in the P&L, okay, but it is actually reflected under addition to fixed assets. Okay, so in this case, it does not, meaning I've not done anything to affect the net profit. Okay, so in this case, I don't need to add back the amount because it's not reflected. It's not taken into account when I compute the net profit in the first place. Okay, so I'll just need to do the second step. I just look at what is qualifying, apply cap. And then when it comes to tax com, the deduction, I'll look at current year, back years, and things like that. Okay, so in this case, there's a difference between the two, depending on how the qualifying expenditure actually reflected. Whether it's reflected there something in the P&L that will affect your net profit, or not in the net profit thing at all. Okay, so things to note that. And then for info in the exams, right? In a tax com that you will see, you will not be like, you know, everything nicely in P&L. It could be that sometimes it could be maybe somewhere, maybe sometimes they say, oh, not in P&L, but let's say in fixed asset. Or sometimes it could be that it's as if, you know, the taxpayer do it wrongly and then account it under some other expenses. But of course, there'll be notes to say something. So in this case, in the exams, right, that's why I say it's better that for the tax com question, you look to at least have an idea of what the items are, not just the main P&L, but also on the notes. Because some of it could be in the note and further down, you know, it's not directly related to expense item. Anyway, this is just some tips for you. So then from there, you make the adjustments. Okay. And for the tax com, maybe some shouldn't be expenses, but reflected as expense and things like that. So it will not be very nice puzzle in neat categories. They can be everywhere over the place. So because it's a practical question, so it's for you to apply the correct concept. Okay, then I move on to the next expenses. That will be the statutory and regulatory expenses under section 14V. Deduction is allowed for qualifying statutory and regulatory expenses. Okay, so those expenses, if they are deductible under section 14.1, will not be deductible under section 14 capital V because we don't want to allow double deduction. Okay, so these are very common expenses, which I would say that, you know, will also be shown somehow in your tax com. Then you see whether you need to make any adjustments, or maybe, you know, if allowed, then you don't need to make adjustments. Okay, so go through a few categories. One will be to comply with any written law of Singapore or any other countries. Okay, so for example, for expenses incurred to comply with the Income Tax Act. So when you prepare, you engage services of agents, for example, to prepare the income tax computation or to reply to IRS's inquiries, deductible. Okay, or you engage your auditors to prepare financial reports and things like that, deductible, audit fees deductible. Okay, or expenses incurred to rectify any non-compliance with such requirement, deductible. Okay, but if you look at the note at the bottom of the table, it says that for expenses, right, incurred to defend against charges of non-compliance with any statutory or regulatory requirement, okay, or expenses in relation to appeals to the court, they are not deductible. So even though when you can claim expenses on your preparation of tax computation, but let's say because of receipt, then you disagree with the controller, you say not taxable, controller say taxable, you apply a badges of trade and things like that. Then you disagree, right? So you bring your case up to the board of review. Just like I mentioned about the board of review, right? So these expenses that you incur, to defend against all these charges at board of review or even to the high court, these are not deductible. Okay, so you need to know that there's a distinction, between the two. Then we also have qualifying expenses, which you incur to comply with any code standard requirement that is issued by the government or public authority in Singapore or other countries. So if you look at the examples, we have like the expenses that you need to incur to comply with those directives issued by MAS, ACRA, and things like that. Okay, then your annual listing fees to comply with the SGX listing manual. Okay, then you rectify non-compliance. Or you may also incur expenses to study the impact of any proposed law that's not yet to be enacted. Okay, so we have some examples here. These are like the foreign type, but may also affect your business activities. Okay, so then we are also looking at expenses that is to prevent or detect any non-compliance with the law. Okay, so in this case, very specific case, I just remember the GST ACAP expenses is deductible. Okay, then those audit fees, if you are doing the law say don't need, but you voluntarily comply, is still deductible. Okay, then what is not deductible will be those that are capital in nature, where we have our incorporation fees, strike-off fees, liquidation fees, your IPO fees. So these are not deductible. Okay, then I'll move on to the deductions for other items. Okay, these are also quite common items that you'll see in the tax com. Okay, then we have foreign exchange difference. Okay, so your transaction may not be in local currency, can be in more than one currency where you may incur, there may be foreign exchange differences. So then you have to look at what is the underlying asset or liabilities. Then you apply the tax treatment. So basically, you need to know that if the underlying is on revenue account, right, then that is taxable. If it's a gain, that's taxable. If it's a loss on revenue account, then that's deductible. Actually, relating to trade, then we'll apply the normal rules. Gain taxable, loss deductible. But if it's on capital account, you can see those examples there. If it's on capital account, then the gain is not taxable. Remember, we say gains that is of capital nature, not taxable. Then similarly, if it's a loss, not deductible. Okay, so we have this concessionary treatment, which I'll just leave you to read on your own. There's an e-tax guide. Basically, what it's just trying to say is that generally for year-end balances, we take it as capital account, but some people, they may say that, hey, it's all for trade, then you treat as revenue. So there's an e-tax guide on this, on how you do it. Okay, the thing is that we need to know, okay, so in theory, we know what is taxable, what is not taxable, but then how do you make adjustments to the tax com? Okay, so if you remember, to arrive at the net profit, whatever receipt is already featured there already. Okay, so what will happen is that if it is not taxable, because they will say that I have this gain of $100, right? It will be included inside your net profit. So if it is not taxable because it's capital on capital account, we have to take out this gain. Okay, but if it is a revenue account, no problem because it's taxable and it's already included inside as part of net profit. Okay, but for loss, similarly, if it's a capital account where it is not deductible, under normal circumstances where we prepare accounts, right, you have already included as an expense. Now you have to add back. Okay, because it is not deductible. Okay, so the theory is one thing, how you make the tax com is another. Okay, then we go to other items like compensation for and damages paid. So it is deductible if it is incurred for three purposes. Fines and penalties not deductible. I mean, we don't want to encourage people to break the law, right? So fines, penalties not deductible. Then your insurance premium for group term life insurance policy, it is deductible. Okay, but the company can actually elect not to claim the premium. Okay, but it will have implication on the employee side, but can elect not to claim. Okay, then the insurance premium for work injury, for insurance for work injury compensation, and is deductible. Then specific provision for stock obsolescence deductible. So this is on the deductible part. Specific provision for stock obsolescence deductible versus if it is a general provision. Remember, we are talking about section 14(1). If it's a general provision, we do not allow deduction. Okay. I will not be, okay, the next session, then we will go through the part on 15. Okay, but what I would like to do is that I think, because you're saying that some of you, I think because of, just now I was sharing on the tax com, right? The exam. So I thought I'd go through with you since you all don't have the thing with you. Actually, I think we've checked lah. So we have told CPA to load it. Somehow it wasn't loaded in our online portal. Okay, I'm showing the tax com. I hope you can see. If not, then you just tell me. Okay, I was saying this is what you will see in the exams, right? Okay, so you have your tax com, then net profit. Then these are the notes, which I say that it is important that you go through them at a glance first. Okay, because if you see, like, I will have like note 1. Okay, then we'll tell you what is note 1. Okay, then some notes you can see can be rather long. See, some notes can be rather long. So it may have implication on your claim for CA, for the 14N, whether it's deductible or not deductible. Okay, so this one, this is the net profit. The end of it, you see your net profit. Okay, so look at the notes first, and then this is what I mean by look at the question. It's important that you see, you need to show working. Okay, and in this case, it says that the company has applied accelerated deduction. Okay. Now I will share the answer for case study 2. Okay. See. So just now I talked about deductions, right? Those, okay, like I say, net profit, you indicate net profit, you really get 0.5 marks already. Okay, so for everything here that you make adjustments, you'll get 0.5 marks. Okay, so for those expenses that are not deductible, you need to add back. Okay, so if you add back correctly, you get 0.5 marks. Okay, those that no, you may need to show workings. You can say something like see workings, then you show in another page. Okay. So for capital allowance, usually you also say see working. Okay, just like I mentioned, like for dividends, like these sections that I've quoted, you don't need to quote sections. Okay. Like those that are exempted, you don't need to even put them in the first place. You only add whatever that is taxable. Okay. So like, for example, later on next session we'll touch on donation, but you show your workings like times 350%. In case sometimes you may get 1,000 correct, but you don't apply the right percentage, instead of one figure that you don't get any points. If I see like, for example, you get 250% correct, or you get the amount correct, I will still award points. Okay, then we're talking about the partial tax exemption part. This is at the later part where definitely you need to work out this part. So you just know this is the format. Okay, so the workings so medical expense restriction, we have gone through that earlier. So you need to show like for each item, what is the total remuneration, then how you apply the cap and things like that. So you don't just, in the exams, you don't just like give me some figure, because in case, let's say you don't get the amount to be added back, if any wrong, but let's say you still get, let's say you do your total remuneration correct, but you apply the wrong percentage, at least I can still give you marks for those items that you got it right. Okay, so this is how it will be marked. Like say for capital allowance, I don't need you to quote sections. This is just for your learning purpose that we quote the section, but you can just like if need, divide by 3. If not, then things like that. Okay, like I said, you don't need to say what is the reason. Okay, I mean, I'm just trying to so better to be familiarized with the format, especially when you don't do it often. Okay, like I say, the info will be all over the place. It's for you to apply it. Okay, so it's time. We'll have another session next week, starting at 9 a.m. sharp. Okay, so we'll go through the rest, and also at the end of second session, I'll also go through the exam again, what to look out for, things like that. So any questions? No worries. I mean, if any, we can still cover them next week. Then if not, then maybe I think we can end the session today. Lei Hong.
Thank you. Yeah, thank you, Shirley. Sorry, Shirley, let me do a quick look at that question. Just ensure that all has been.
Sorry.
Can you take a quick look at the chat questions to ensure all has been?
Just one.
Just take a quick look.
Okay. Sorry, usually I don't check the chat. Okay, whether appeal succeed, is it deductible? That is on. I presume on 14B. I presume let me know if I'm not correct. So just now I mentioned that if you need to defend against I say the tax treatment in the board of review, we don't allow expenses. So what if the appeal, let's say the taxpayer is correct in the tax treatment, it's just that, for example, the taxpayer is saying that this amount is not taxable, but IRS has brought it to tax, right? Then we'll make adjustments to that amount so that it is now not taxable, but we still will not allow expenses. So the deduction of expenses is not being determined by the outcome. Okay, then what is the difference between repairs and renewals, renovation, and refurbishment? Repairs, like I say, it is something that you put back in place. Okay, R&R it's the renovation type where you have to like redo the place up generally lah, or you need to like general lighting, all this, maybe it could be an improvement. Okay, but so sometimes you have to look at it. If it is straightforward under revenue, then that will be the best. It's the revenue expense because there's no restriction. If you are claiming it under section 14 and there's a restriction because you will utilize your cap. Okay, so generally you will want it, I mean, if they fall within the correct category, you want it under 14.1. But of course, like I say, there's a difference between renovation, because renovation you could be doing, there could be an improvement. So you won't meet under claim for repair. And then, what if the amount paid by a customer has been stolen by the employee and the company is not able to recover? Okay, I think in this case, there's something to say is that it depends on whether there are proper checks in place and whether the employee has the power. So if let's say it is once you read newspapers, like sometimes they have, okay lah, they do some work to it, but let's say I have proper checks in place, the short answer is that yes, you can claim a deduction. Okay, but of course, if you recover it later, you have to add back. But if let's say it is the company's director that embezzled and things like that, then that's a different story. Okay, because the director has the power. By right cannot but then no one to check on him, then that you cannot claim a deduction. Okay, then the badges of trade one, I already addressed them. So, okay, I'm not forget. Ad hoc, what's the difference between ad hoc contribution? Contribution cap is fixed, but ad hoc it could be not is it it could be mandatory it can be like, it depends on the employer. This year they can contribute because they do not claim as much medical expense depending on the rule. Also depends on the CPA rule. Okay, so cap is always fixed, but the ad hoc can still be mandatory. Doesn't mean that it is always okay, maybe you're okay. Ad hoc, if it's allowable since it's allowable, I mean we have stated, right, what is allowable, then you can claim a deduction. Because you can say ad hoc is also voluntary, right, which is true. Carmen, I hope I've answered your question. Okay, anything else? I think if not, then or if you can think of anything, then next week we can continue.
Okay, Ken. Thank you, Shani. Thank you, everyone. You all have a good lunch.
Okay, so again, next lesson will be at 9 next week. So we'll start on time.
Okay, Ken. Do be punctual. Yeah. Thank you.
Okay, thank you.
Bye.